Alicia Alt. I am with Credit Score Pro. I'm one of the founders. So obviously Ivory here is the other founder. But just to give you a brief introduction, because I hate talking about myself anyway, the reason that me and Ivory had created Credit Score Pro is that we're both in the credit space. I've been a credit expert for the last 20 years. I think we're going on 21 at the end of this year. My sole job was to help improve people's credit. It came from the mortgage industry and kind of transitioned into that. And today our passion is being able to bring that credit help to consumers anywhere, no matter where they're at and what position in life they are. So we're really excited about Credit Score Pro. And I'll leave it at that and let Ivory introduce herself.
So my name is Ivory Becker, also co-founder of Credit Score Pro AI. So Ali and I came together after being in the industry for a very long time. I'm going to leave it at that. And you're bearing with me while I'm doing technology at the same time. So thank you.
It looks good. Good job.
I did it right today. So both of us have been in the credit space for quite a while. Ali has an extensive background in lending as well. I suppose I put it on the screen. And there are some issues for all of us, whether we're on the lending side or the professional side in general, or the consumer side. There's just not a lot of information about credit in general. And then not a lot of tools and resources for navigating credit and navigating credit issues, or learning how credit works and maintaining credit. And so that's really what we do, is we help to fill in that gap for both professionals and consumers. So that way we can solve those problems and help everyone be more successful when it comes to lending opportunities. So that's why we're here today. And today we're going to be talking about navigating your credit report, essential insights for consumers. So I'm going to dive right into it. But I'd like to remind you, if you have questions or there's certain things you want to discuss in more detail, just let us know. We would rather not just sit here and talk at you. We would prefer this to be interactive. So if you are on the live on YouTube or Facebook, feel free to comment in the chat there, and then we will definitely make sure we respond to you and address your questions or comments. And then same here, if you're in the live, just unmute yourself, or you can type in the chat too if you want to stay muted. We do not mind either way. So
also, if we could just add, if someone is watching a live after the fact, but it's not live anymore and they're watching the recording, comment on the live and we will get back to you on that as well.
Absolutely. Okay, so the credit report, what is it? Why does it matter? So if we look at a credit report, we can really think of it as a financial resume. So when you apply for a job, you need a resume, right? It looks at what's your background, your qualifications, and how does that make you look, said differently. So really with your credit report, I think it's helpful to think of it as when you compare it to something else we're familiar with. I think credit reports get very convoluted and confusing for people because there's a massive amount of information on a credit report. And we're going to look way later on why that amount of information matters and how it can be beneficial to you, how you can take advantage of all of that information if there are issues on your credit report. So we talk about this slide, information overload, because if you've ever looked at your own credit report, if you have a lot of credit history, it can be a ton of pages and there's tons of information. There's tons of things to look at. And you often don't really know where to start. So we need to simplify it. So let's start by talking about the credit scores first. So the credit scores are really just a tool to summarize the information on your credit report in numeric value, right? The higher your credit score, the more likely you are to be accepted for lending opportunities, and the lower your credit score, the more risk. So you can think of it as a risk tolerance tool. So the analysis of the information on your credit report by the credit score algorithm is what determines that score that you see. So the whole point of a credit score is to say, how much risk am I taking on as a lending institution to allow you to borrow money from me? Make sense? So when we talk about that, we also want to understand the credit bureaus. They're the ones that are showing that information on your credit report. The creditors, so the credit card companies, lenders, everyone who reports information sends it to the credit bureaus, who are Equifax, Experian, and TransUnion. So they're gathering all of that information, and then they're utilizing the score models provided by FICO. We'll use FICO in this example, or Fair Isaac Corporation, as they were called. They give that algorithm that helps to analyze the information and determine that credit score that you see. So banks and other lenders want the most accurate information possible. So they're sending all of the information they have on you, like how you're paying your credit cards, and send that to the bureaus to try to make that score as accurate as possible. So that way they know in the future, if they're ever going to let you borrow again, they know what your behaviors are, not only with them and their institution, but other institutions as well. And one important thing to know is that those creditors are paying the credit bureaus to report information. So sometimes you may notice a creditor only reports to one bureau or two credit bureaus. And that's primarily because they do have to pay to report. So they pay each bureau separately for that reporting. And they may deem that they only want to pay one bureau, for example. Anything you want to add to that, Allie?
I think just because of what she said just now, you'll see, different scores across the different bureaus. So you could have, I looked at one today, he had a 718, and then he had a 500 something and a 600 something. They were all over the place. And it was because one, some creditors didn't report to all three. And then the other factor that, she didn't say in this, but it's real, is that information can be different across those bureaus, even if they're reporting to all three. So it's interesting that the credit scores can be so fluctuated in multiple different reasons, but those are two really big reasons.
Absolutely. Yeah. Thank you. So credit scoring models. So have you ever noticed that your credit scores, if you're using Credit Karma, are different than when you go to apply, let's say for, I don't know, a mortgage or even a credit card, right? The main reason, there's a couple different reasons, but we're going to focus on one main reason. The one main reason you may see different scores is if you're using certain credit monitoring softwares, or I don't know if I want to call it a software, but basically softwares, or credit monitoring tools. They may be using a Vantage credit score or Vantage score or a FICO credit score. So those are two different algorithms. So they take all of the information on your credit report and they calculate it differently. So in March 2006, that's when Vantage score was introduced. Otherwise, prior to that point, since we've had standardized credit scores, is my caveat, we've been using the FICO score algorithms. So I wanted to put up on the screen the two different algorithms, right? Or models, if you will, not algorithms, but we've got the FICO score and we've got the Vantage score. So while they're both looking at the same information on the credit report, the way they're calculating that information is different. So there's a higher weighting for certain categories and a lower weighting for other categories. I'll let you add into this, Allie. I know there's a lot we can say here, so.
Yeah, there's a lot that we can say here, but I do think that this is important that we're looking at these two models, because even though Vantage score is not widely used in the lending industry at this time, it will become widely used in the next couple years. So I think it's important that we really know how that system works, as well as the FICO. But notice that because there are differences, they are, like Ivory said, they're looking at the same data, they're just scoring it differently. And that's what these models show. And that's why on the Vantage score model, you tend to see people with higher credit scores. So if you have a consumer that says, I went to Credit Karma and I pulled a 640, but you're pulling a 500, right? And they're mad at you. You can kind of explain that these are different and they do score differently. In the mortgage world, I call the FICO scoring system the mean one. So you can use that term to them, like, well, I'm sorry, we use the mean one. But I think it's really important that we do understand both, because they are both going to be very present in our lending space in the next couple of years.
Absolutely. And It was a perfect segue because when we look at FICO scoring in general, the reason I wanted to show you this is because FICO credit scores are used in 90% of lending decisions currently, right? Currently 90% of lending decisions. So we are starting to see a shift. The Vantage scores are going to be, or are actually, the rollout for Vantage scores being used in the mortgage industry is happening. And the point of it is meant to create wider accessibility to consumers for lending opportunities. The reason why Ali had mentioned the mortgage FICO as being the mean one is really because it's the oldest version. So on the screen, we're showing you the different versions, and you can think of it like the iPhone generations. As time passes, the FICO algorithm, they want to make the next greatest algorithm that's going to be even better, more predictive, more accurate, right? So they come out with a new version, but the mortgage industry is leery to make sweeping changes, especially with the tool that's used to mitigate risk. So they're still stuck using version 1, right? They're on that oldest iPhone. They trust it. They know it. If you know anyone who, never wanted to go to a smartphone, that's like the mortgage industry. They wanted to keep things the same. Okay. But now we're starting to see a transition. So I know, John, you had the question, do lenders accept either Vantage or FICO currently? Most lenders are accepting FICO right now, in most industries. We do see Vantage scores more widely used for things like rent, like for if someone is applying for a rental for an apartment, because they're cheaper. So
And some commercial lenders will use it, but that's even very sparkling. Like there's not many.
Yeah. I've seen it used in hard money lending as well. But in general, FICO's been the standard for so long. It's known, it's trusted, it's well accepted that it's still being more widely used than anything else. And like we said, we're starting to see that transition take place. So it'll be interesting to see the rollout over the next couple years, as they start integrating the Vantage scores into specifically mortgage lending, but it will likely propagate elsewhere as well.
Yeah, I believe once the mortgage company integrates it, it's going to be widespread throughout any lending. Because if you think about it, like if you go to Chase Bank, they do mortgages, they do cars, they do everything. So they're going to want to probably stick with one model of usage. So I think we're going to see that big transition in the next couple of years.
Absolutely.
Which could be a good thing. We believe that the old predictor, using Ivory's term, iPhone 1, is not a good predictor of whether or not someone's going to pay their obligation. Okay. And so we are, with the mortgage industry, we're stuck there, but it's really not a true predictor. So we really do need a transition. And it should have happened a long time ago. So I'm excited about the change, but I think what's going to happen is, for those of you in that space, when that change happens, we're going to likely see scores higher than they are now. Your person today, same information would have a higher score.
In most cases, yeah.
Yeah. And what is likely to happen in that case is you have, the buyers of debt who are the ones who make the decision about how they're going to buy that debt and what the credit scores have to be. We might see an increase in credit score requirements as well. So everything comes with good and bad, right?
Right. Those minimum scores are likely going to increase. Is that what you're saying?
Exactly. Yeah. Your different tiers are likely to increase. And I've already heard a lot of talks about that. That's almost a given. And that's part of the time frame of transitioning into this new version, is that, the people who buy the paper are the people who control, what we're going to do and what we're not going to do. And they have to be involved in that whole discussion.
Absolutely. Yeah. But yeah, there's a lot more we could talk about on this specific topic of versions of scores.
We could bore you.
Yeah, I mean, we can really bore you, but we won't. We won't today.
We won't.
If it's something you're ever interested in, just a deep dive on, let us know. We're happy to do a live just specific to those algorithms and how they function differently and why auto lending looks at one and mortgage lending another and all of that. So, okay. So that leads us to what score matters. And I think we kind of talked about that already. So up till recently, FICO was the score that matters. And all of these models really matter, just depending on what type of lending opportunity you're looking for, from auto lending to credit card lending to mortgage lending. But now we're starting to see that shift. So the bottom line is better scores are meant to measure credit health, right? So or both scores are meant to measure credit health, and better scores, or i.e. higher scores, are essentially showing that you've taken really good care of that financial report card that you have, right? And that's really the point of the credit score, is to be predictive. So over time, it is going to continue to morph and change, especially as our technology continues to advance and our predictive modeling gets better and better and better. And that's kind of my subtle peek for what is to come with trended data and credit scoring, which we'll do another live on in the future.
Yeah, that's a whole new animal. So that's coming out. Just if you can go back to that slide just one
Absolutely.
second. I love the title of the slide, which score matters. If you're in the industry, you may indeed have consumers who say to you, well, I saw this score, when I went to buy a car, the mortgage company's telling me this score and Credit Karma's telling me this score. Which one's my credit score? I hear that a lot. And the answer is it depends on what you're doing. Right. And that's the true answer. So the auto loan is right. The mortgage company's right. And, well, Vantage Credit Karma probably isn't right now, but it will be. So
Yeah.
I just tell them, like, listen, it just depends on what you want to do, and then kind of discuss it. But I just think that was, yeah.
I'm sorry, because all of these numbers will be different, just to clarify what you're saying, right? They are
Yes.
all correct. They just are all going to be a different number because they're interpreting that data differently, right?
Mhm.
So,
Yeah.
okay. So why you're here? Let's break down the credit report. That's the whole point of today's live.
So boring. So boring, guys. Just tell you now.
I like to start with what cannot be used in a credit report. I think this is important because we are one of the very few countries that doesn't allow this type of information to factor into the credit score. So our scores are really designed not to be discriminatory, okay? So it's really meant to only focus on the financials and what's going on with debt that's being paid. So another thing that's not on here. So we've got race, religion, national origin, marital status, your gender. None of that can be used to factor into your credit score, but neither can your place of employment or your income.
How much money you make. Yeah.
Yep. None of that can.
I have a lot of people say, why I make more money, so why don't I have a higher credit score? They don't even know what you make. So that's not involved. But I like how you said that in our country, because in other countries, these criteria that we would think like, wow, why would anybody want to know that? These are used in credit models throughout different countries. It's very interesting.
It is. It is. So what actually does influence the credit scores? So we saw on the other slides, this is a picture of FICO. We're focusing on FICO right now because it's the 90% of lending decisions. So just my point of clarification. So we're going to start diving into each of these sections, but the main points are your payment history, capacity and amount owed or credit utilization, the length of your credit history, new credit and inquiries, and then types of credit used. So the next sections, we're going to break these down and look at some of the myths and some of the facts with each of these sections, so you know how to interpret the information on your report, or if you're a professional, your client's reports. Okay, but before we do that, what if there's not enough information on a credit report? So if you have a lack of robust history on your credit report, you could have no credit score, or you could have an extremely volatile credit score. Like up and down, up and down, up and down. You're seeing these big swings. Let's say you only have a few accounts on your report. You max out your credit card 1 month and your score drops 100, 150 points. That's because there's just not a lot of information. So it creates these wide swings. It's kind of like if you've ever talked to a financial advisor about an investment account, they want you to have a variety of different types of investments. So that way it creates this cushion for the volatility. So the swings aren't as big, right? And it's the same with your credit profile. Anything you want to add to this, Allie, about no credit scores?
No, you really did a great job.
Okay.
Oh, well, maybe there's help. You don't have to not have a credit score. You can fix that. You can fix the lack of sufficient information.
And you don't have to drive yourself into debt doing it either.
Correct. And a lot of people do when they're trying to do that. So it's a good point.
So the first factor is payment history, right? This is 35% of the score. Biggest overall factor that contributes to credit. I think most people would understand why it's the biggest factor. With payment history, some of the important things that I wanted to focus on are when is negative information impacting your score, right? So when you're past due, let's say your credit card's due on the 1st, you don't pay it till the 20th. You don't need to call us panicking that your credit's been impacted because it's only 20 days past due. So not that we're encouraging you to pay your cards 20 days past due, but if it happens, a mistake happens, just know your credit is not impacted until you're 30 days delinquent. And if you're someone who has experienced, or you have a client who's experiencing financial hardship, one of the best things that you can do is call that creditor to see what type of hardship options they have. There are modifications to reduce or temporarily eliminate interest. There are modifications just to reduce the payments as well. There's deferment or forbearance options. So that these options can prevent the accounts from showing past due on your credit report and allow you to get through that hardship and mitigate that potential risk to your profile. Because if you do have a new negative event, a late payment, 30-day delinquency, let's say, that's on your credit for 7 years, right? So for 7 years, that blemish is going to be there and it will impact the credit score to varying degrees depending on the credit score algorithm. As far as modifications go, no, they don't impact the credit score. There may be a note that says that an account was modified, for example. So a creditor will see that you have a modification on your account. Often we see that when it comes to mortgage modifications, for example. What's really important to pay attention to, and I'm going to give an example, which Allie, I think you're probably thinking about, is during COVID, we had several people that did forbearance with their mortgage lenders. And when they agreed to the forbearance, they were past due, right? We'll say 120 days past due for my example. In the contract for the forbearance, it indicated that if they were past due, they were going to continue to be reported delinquent on their credit until they caught up after the forbearance. So that's a scenario where credit unfortunately was impacted. Now you can argue that it could have been worse, right? They could have been foreclosed on instead, but that's a pretty severe impact, especially if they got a 6-month forbearance and they're being marked past due for those 6 months that they're in forbearance. So the terms of the modification do, of course, matter. And it's really important for the consumer to ask those questions, read through the modification documents and modification terms. Often they're not as big as an original contract, right? They're readable. There's no excuse not to go through it. But there may be options available there may be a different option available that you choose, but if you're backed against a wall and that's your only option, sometimes it unfortunately will impact your credit. I'll let you go ahead, Allie, if there's anything you want to add.
Yeah, I was just going to sum up, like, a modification itself does not negatively affect your credit score, but sometimes the way that they set it up in their contract and how they do it can. To give you a brief example, one of my clients did a modification on his car loan. And they reported him 30 days late repeatedly, even though he thought the modification was going to prevent that, because otherwise he was going to find the money to not be 30 days late. So it's a really sad situation that he didn't have the contract in front of him to state that they were still going to report him late, even though they were helping him. So that was really sad to know, because he would have found the money. And so I think it's important that you just know how they're going to do the reporting of the modification. Are they going to, keep you in good standing, or are they going to cause you to, show a delinquency? Because that does happen. The other thing you have to be careful about when you're doing modifications on a mortgage, and then let's say you now want to go buy a new home, that notation of modification could be an issue for a new lender, because like, wait a minute, you're in a modification for a mortgage, but you want me to give you another one, you want to buy another home. And so there's some factors that might prevent them from purchasing another home when they're in a modification of a mortgage.
I think one thing I should clarify too is repayments versus modification. So sometimes people get a repayment plan to help them catch up on past due balance, and they think that that is a modification. A repayment plan is basically typically just a verbal agreement with that creditor that you're going to pay a set amount to help you catch up. It's not a true modification. It's just an agreement to help you get caught up on the payments. So I know in the past, especially back during the financial crisis, we saw a lot of people that were electing for repayment plans over modifications, not understanding the difference between the two. So, yeah.
I'll tell you, the creditors, like when we're talking about credit card companies and stuff, they oftentimes have really great hardship programs, and they will not report lates after that. When they put you in the hardship program, ceases reporting of any negative information. They typically do close the account. Some will close it temporarily and reopen it once the hardship is over. But some of them have some amazing programs that really benefit the consumer and also don't hurt their credit, like going to a debt consolidation company when they're in a crisis. So I think it's super important. I love that you have that on that slide. People should contact their creditor before they do anything else, because there may indeed be some amazing help. I've seen credit card companies drop the interest rate to 0.
Yep.
I mean, that's a true thing.
Yep.
So
yeah, essentially, don't wait until you're already past due. You can call before you're past due.
Yeah.
Okay. So that's
great.
And I think with this category too, kind of going away from the negative payment history, people forget about the positive payment history and how important that is to your credit. It goes back to having enough data on your credit report. So don't forget, positive payment history helps too. A great example is someone who has a couple late payments but only has 3 open accounts on their credit report. They're going to see a really big hit from those couple late payments versus someone who has this really robust credit profile that can create, I'm going to call it some cushion, if you will. Now, of course, there's other factors that contribute to how much they're impacted, but having more history is helpful. Having more on-time payments, continuing to report month after month, even if you've had, oh darn, I didn't realize my bill pay stopped working, or I got a new account, right? So
very good.
And I think we talked about this a little bit, but how does negative history impact my credit score? So there are levels of severity to the negative payment history on your credit report. So a 30-day delinquency is the least severe as compared to, of course, a 90-day, 120-day, and eventually a charge-off, right? Allie, do you want to talk a little bit about late payment history? Anything we didn't cover?
I like this that you have here. Negative payment history from the last 2 years is more impactful than negative history from years ago. So that 2-year period, that first 2-year, most recent 2-year period, is where the hard hit to a negative is on your credit report. After that 2 years, it's not as much of an impact, right? And the older it gets, less and less. And I like that, because a lot of people get really crazy about they had a 30-day late from 2020. And I'm like, hey, listen, if we don't get that off, it's no big of a deal, right? It's what happened in the last 2 years is the most important part.
Yeah, absolutely.
Oh, and talk about the bankruptcy, because people don't understand how bankruptcies come off the credit report. I always hear people say that it'll be off my credit report in 7 years, and that's not true.
So I think there's a few things to focus on with bankruptcy. A lot of times people don't realize that the accounts that were part of the bankruptcy are going to be marked, right? There's going to be a negative impact for those accounts. They just think, it's fine. They were all part of bankruptcy. I'm fine. It's all wiped clean, right? But each account that was part of the bankruptcy is going to have a notation that it was part of the bankruptcy. It's going to be considered a derogatory account on the credit report. So I think Allie, what you're pointing out is the bankruptcy, the differences between the chapters. Is that correct?
Yes, ma'am.
Yeah. So chapter 7 bankruptcy stays on the report for 7 years. But
Chapter
13.
chapter, you
Chapter,
said
I'm
chapter
sorry, I said it
7.
backwards. Sorry, I
Don't
said
say
it
it
backwards.
backwards. You're going to confuse everybody.
Well, it's because I said 7, chapter 7 bankruptcy, and then thinking of 7 years. Chapter
This
7.
is why we do this together, to make sure we don't say the wrong stuff.
Chapter 7 bankruptcy stays on the credit report for 10 years. Now, Chapter 13 is handled a bit differently, right? So a Chapter 13, if you're not familiar with that type of bankruptcy, often known as the wage earners bankruptcy, essentially you are entered into a payment plan, right? So those can last for a different amount of time.
3 to 5 years is generally.
Yeah, generally 3 to 5 years. And that is going to stay on the credit report for 7 years. So a little bit different in the timeline. And your creditors are going to look at a Chapter 7 versus Chapter 13 potentially differently as well, depending on the type of debt you're applying for.
And a little known secret that a lot of people don't know is if you are currently in a Chapter 13 bankruptcy, you can still buy a home. You have to be in that for at least 1 year. The trustee has to agree to it. Like you have to be able to afford it, that kind of thing. But that was when I was in lending. I did a lot of home purchases for individuals that were currently in a Chapter 13. So I just thought I'd throw that out there as another little, not that it made any sense to this slide, but
that's okay. Credit utilization. I think this is probably one of my favorite ones to talk about, maybe for you too, Allie. Let's talk about what credit utilization is first. So utilization is 30%. So second biggest factor to your credit score. It is looking at what is utilization? It's looking at your balance versus your credit limit, or how much we'll focus on credit cards first. Your balance versus your credit limit. So what is your balance compared to the limit they've provided you? If you have your card maxed out, you're going to see a big drop in your credit score from maxing out that account. And with utilization, it's looking at each account individually, as well as holistically on your credit report, what your balances are versus the credit limit available to you. So it's really looking at things in 2 different ways. Paying down your cards helps your credit utilization. What's very important is if your cards are not open and active, they're not going to be helping your score, right? So you may think, oh, I have these 2 credit cards on my credit report. They're helping my overall utilization ratio because I never use them. I haven't used them in 8 months. Now they're no longer helping your utilization because they're not active. That credit score algorithm wants to know that the information on your report, that data is viable, that it's good data, right? And if there's no activity on the account, it's going to say, hey, this is not reliable information. So I'm not going to factor it into the credit score. And that's where a lot of people get in trouble, is they don't realize that there's some aspects of credit that are just not as intuitive as you would think. So
yeah, it's not common sense sometimes. I hear people all the time, I'm going to go get these credit cards and I'm going to cut them up. I'm not going to use them. Like, okay, well, that's not going to help you. It's just not. So
Allie, how often should we be using the credit cards?
We should be using them at least once every 3 months to keep activity on them. And it does 2 things. It keeps activity running on the credit report, but also number 2, it keeps that credit card company from closing due to inactivity, because they could close it on you too. And we definitely don't want credit cards closing on us, because then we're also losing the average age of account, which we'll get into well next.
Yeah,
but just like seriously on this utilization, and Ivory said it was her favorite, it's probably my favorite too. This is, she calls it the yo-yo effect here on this slide, but I like to call it the roller coaster. As your utilization changes, your credit score can go up and down. And people always ask me, why is my credit score so high this time and next month is low? And a lot of it has to do to this utilization. But keep in mind, we're talking primarily about revolving accounts, which are credit cards versus loans. So I don't know if you want to pipe in on anything on the loan side and how that works, or you want me to talk about that?
I thought you could do it. That was going to be what I wanted to go into next, is the loan side of things. So
loan side, we don't care. You can be maxed out on a loan. It's not going to hurt your credit score. Okay, so that's important to know. So if I go get a new loan today, I might see a drop in score because I have a new loan, but it's not because of the utilization. But as I pay it and show that I have good history, my credit score is going to increase. But there are situations, and this is very common with student loans, where a student gets a loan, they're deferred while they're in school, but what they don't understand is if it's an unsubsidized loan, their interest is gaining on that loan. So they get out of school, they got a loan for $3,000, probably more than that. But let's just use that figure. They got a loan for $3,000. Now they owe $3,500. So when you look at the credit report, the high balance was $3,000. Their balance, high balance being like the credit limit almost, their balance is $3,500. Now it's dropped the score. They didn't do anything wrong other than ignorance of how the credit system works, right? So I think that's really important. And I have seen recently some like furniture stores and stuff giving people a credit card or a loan.
Yes.
And the loan will be like, some of them do credit cards, some don't do loans, but the loan will be like, I gave you a loan for $2,000, but I sold you furniture for $2,500 because of the taxes and the other stuff on it.
Right.
But they put that full balance at $2,500 on the loan, but the loan was $2,000. So that really hurt the person's score, and they see a big drop and they don't understand because they weren't told that, and so that happens. So yeah, this is a big category. This could really change a credit profile really fast.
And Allie, we have a question before I jump into it. One thing I think I'll mention too is if you are somebody that has high utilization on your credit cards, one of the things that you can do, caveat, if you can qualify, if that debt is moved from revolving to installment, that can help the utilization on your credit report, right? Because again, as Allie had mentioned, the loan balances, again, as long as it's not more than what the original loan amount was, are fine, right? You can have that full amount transitioned over to installment, and you're going to see an improvement in your credit score from doing that if you are someone who has your cards maxed out. Now, you do have to qualify, right? So you can be in this kind of weird conundrum where if your scores are too low, you may not qualify for the installment loan, but there's definitely opportunity there for transitioning balances.
Yeah, if you're thinking that you're going down that route and you're struggling, which a lot of people are right now, before you max it out, go apply for that loan so that you have it to cover those expenses. It's such a great opportunity for two reasons. Number one, now, and I've done this so often with clients, they'll come to me with a 600 score. We get a small personal loan, pay off the credit cards. Now we're in 700s, right? So what I essentially did for them is, number one, improve their credit score. Number two, I put that credit card debt, which right now is like a whopping, like a lot of people, 34% interest rate. That's crazy. And then they get the loan, and their loan interest rate on a bad day, a lot of times is 17%, right? We're still doing a lot better. So financially, we've helped them. We've helped them with their credit score. And now they're right. And it's amortized differently. And then on top of that, now that their credit score is higher, they can go to, back to their car insurance and their homeowner's insurance and have them reassess that to lower their premium on that, because that's a factored by their credit score. So having a high credit score is almost like, in my belief, and of course it's my opinion, absolutely essential in our current environment. So we need to know how to do it. We need to do it right, because it can make or break a person.
Now, Allie, we have a question. How often should you make sure you have activity, and do you have to carry a balance on your credit cards?
Oh, so we did answer the activity part. So activity was every 3 months, right? Balance, no, you don't. But I'll give you a quick story because I think this will make it make sense. I had a client, he went out and got a secured credit card with a local credit union. And I said, okay, you're going to use it so we can build credit. We need to build credit. And it wasn't building credit. It's like, what are you doing? Like, this works. What are you doing? So he tells me he goes to the store. And then as soon as he gets out of the store, he drives to the bank that he got the credit card with, because it's right by his house, and he pays the credit card off. So what he's done is he hasn't allowed the activity to hit his card, for the credit bureaus to get that activity to show that he's making those great payments. So I was like, oh, hold up, wait a minute. You can pay it all the way off, but I need you to wait until a billing cycle hits. So you don't ever have to pay interest. There's like this big myth out there. You got to keep a balance on it. You don't need to keep a balance. Don't pay interest. I have a perfect score. Don't pay interest.
Absolutely.
No, you don't have to.
So, yeah. I like that question. Good
You
one.
like that? You like the answer.
I like your story.
You like my story? Yeah, it's a great story. He's a great guy.
Okay, next. So the next biggest factor, length of credit. This one has a lot of misconceptions. So let's talk about it. I guess let's just jump right in. So length of credit history is 15% of the credit score. 15% might not sound like a lot, but it is. This length of credit history is often the contributor or the thing that prevents people from having that perfect credit score because they just don't have enough age on their credit profile. And where I think many people get confused is they look at their credit report and they're like, look at all these great accounts. I had this auto loan, I had this credit card, I had all these things. They're all closed now. But look at all that history. Look from how many years ago these were. Unfortunately, credit age is only based on open accounts.
What are you doing now?
Once you close that account, it's no longer factored, right? And I think you were going to go into that, Allie.
Yeah, credit scores are about, really, if you think about it, it's what are you doing today, not what you did yesterday. So if it's a closed account, it's no longer factored in. And it's so funny. I get the call all the time, and Ivory, I know you get them all the time too, where someone's so ecstatic because they paid off their car loan and they're like, my credit score is going to improve. I just paid off my car loan. And then I'm like, oh, no, you just dropped your credit score. That was your longest history thing. Maybe financially you did a great job, but credit score wise, you did not, which then in turn becomes not a good financial decision, right? So that's a true thing. If I don't mind, could I give one more story? This happened today.
Yeah, I had one today too. Same.
You did too. Okay. Do you want to tell yours then?
No, you
okay,
go yours. You like.
So I had a client. She had some building credit cards, and she's had them for a year now. She doesn't really have a lot of other history, but she really doesn't like the credit building credit cards. She says they're a little bit harder to use. So she wanted to get a Capital One credit card. She did that. And she called me up. She goes, is it okay if I just close the credit building credit cards? And I said, if you do that, you drop your score. And she's like, what do you mean? I'm like, because now you have a year of history now. Now you won't have any history. You're starting all over again. So I advised her, keep those open for at least 2 years before you start to close them so that, Capital One can get 2 years old, whatever. But I think it's unfortunate. A lot of people don't understand this section of the credit report and how much damage it can do so fast when you think you made a great financial decision.
Yeah. So this morning I was at an event and I was meeting a realtor, and she was getting ready to buy her own house or a new house. She had a house, but buying a new house. And she was so excited to tell me, yes, I just paid everything off. I paid off both my car loans, and my score is going to improve once it reports, I'm just getting myself ready to get ready for the mortgage process. I was like, oh no. So we had that same kind of conversation. Whereas a solution could be, if you're worried about debt to income ratio, have that paid as part of the closing or after you've solidified everything with the credit score when it comes to the mortgage lending process. So there's still ways to make sure your debt is paid off to help you qualify for whatever you've applied for. It's just all about the timing, right? So
timing is a big deal.
That's my 2 cents.
Oh, I feel sad for her. Dave Ramsey did that to a lot of people. A lot of people went through the Dave Ramsey program, and thank you. Exactly. He's got some good philosophies, but speaking to the masses about something he should have been speaking to the rich about, And so,
what a good quote, Allie.
If you're rich and you don't have to get a house with, lending, then fine, don't care about having that debt on your credit report. But if you need a car loan, if you need it, and he was speaking to the wrong audience. Mm-hmm. And I feel sad for that, but because he just hurt so many people in that whole saga. So I think people are starting to learn that that's not the right way to do things. But thank you for the job. I'm glad you agree with me. Some people were iffy about my opinion on that.
Yeah, that's okay. The other thing,
Ramsey is full of shit. Really.
Yeah.
He's speaking to the wrong audience, and he's making a lot of money off of them.
Yeah.
Yeah.
I have a lot of opinions, but I'll keep them to myself. The only other thing I would bring up with the length of credit before we move on to the next thing is just when you open a new account, I think just remember that that's going to adjust the average age of open accounts too. So closing accounts affects it, opening accounts affects it, right? Because it's all about averages, and we know how averages work, right? So as it ages, obviously that's going to adjust the average. So too many new accounts at once can really drive scores down a bit. So
yeah.
So these last two factors are both worth 10%. So you can start with one or the other. So we're starting with types of credit used, 10% of your score. So types of credit is just the different types of accounts. I mean, it's exactly how it sounds. So credit mix, types of credit. The algorithm just wants to see that no matter what kind of debt or credit is extended to you, you can responsibly manage it. So it wants to see that you can pay credit cards effectively, you're responsible with how you use them, you know how to pay off your loans, and ideally you also have a mortgage, right? So you get an added benefit for a mortgage. It's considered a responsible type of debt. It's harder to qualify, it's harder to get, and so you get a little perk for having a mortgage on your credit report.
Yeah, that's great. Can we talk about the purse in this image? Like, just don't do that.
What, you don't think you should have 20 credit cards?
I really don't think that's, I think that person may even have 50. I don't know. I think that's a little overkill.
Yeah, I could have chosen a better image, but
no, I'm just joking. But I think that it brings up a great point. A lot of people think that, you know, and this kind of doesn't go to this credit usage or credit use. You don't need that many credit cards. You need credit cards. I suggest at least 3 open and active credit cards that you want to have open for the rest of your life. That's super important. You know, that we talked about the length of history. Credit cards are the only things that stay open forever unless you have a forever student loan, but some of the people got that forgiven, so that didn't help them. But credit cards seriously are the things that can stay open forever. So you need them, but you don't need 100 of them. And I see a lot of people building credit, getting card after card. I talked to a guy today, he had 7 credit cards. He didn't need 7. He got them all like 1, 2, 3, 4, 5, 6, 7 all at one time. And he's paying annual fees for them and monthly service fees, right? You don't need that 3.
But those credit cards can be your stabilizer too, right? We talked about volatility earlier. They create that stability because things are going to close, right? You get a loan, you're going to eventually pay it off, right? You're going to get inquiries, things are going to happen, and they kind of provide that stability. They help you with the payment history consistently, even if you're not using the card every single month, right? So there's a lot that credit cards can do for you, and you know, it's a double-edged sword, right? Because you have to be responsible, and we have a problem with that in the United States. But the secret to a great score is really having credit card. That credit mix is important too. So we talked about you want loan history, you want credit card history. You can achieve that loan history with things like credit builder accounts. Those are essentially savings accounts that report like loans to your credit. Allie talked a little bit about that before, but there are ways to influence this category without taking out unnecessary debt. Okay. An example of not having enough credit mix would be, let's say a young adult goes to get their first car, but their only credit history is credit cards. They may be declined, not based on their score, but based on their lack of credit mix, their lack of history of ever paying any type of installment debt in the past. So things like these credit builder accounts that report like a loan, but our savings account can help to mitigate those types of issues, and also are a good way to teach savings habits or develop that habit to pay a loan and that new responsibility that maybe a young adult might not have been used to in the past. So,
oh yeah, I love those loans that are savings accounts, because I call it the forced savings. So if people say they struggle with savings, they get one of those loans and they have to make the payment, but it can be like $25 a month or anything. But it really starts to give them into the habit of putting some money to the side.
Yep.
Which a lot of people don't do, unfortunately, and that's sad.
Yeah, they're good for down payment savings too. For, let's say someone has a plan, I want to buy a house in 1 to 5 years. This is my timeline. How much do I need for the down payment? So you can reverse engineer it and say, okay, I want to do a credit builder account for that amount of money. So by the end of that term, I have that amount of money to help my credit at the same time. So
yeah, it's beautiful. Love it.
We already talked about installment versus revolving, so I'm going to move past that. Last section, new credit and inquiries. The slide got a little wonky and I just left it, so we're gonna roll with it. So inquiries remain on the credit report for 2 years. They only affect the score for 1 year, but you are going to see them on the report for 2 years. They are more impactful on a thin credit profile. And the reason is because, again, lack of data, not as much information to go off of. So you see more of an impact on someone who has very, very sparse credit history. Soft inquiries have no impact to the score. Hard inquiries do, right? So soft inquiry can be for like utility bills, cell phone bill, a
Auto
job,
insurance.
yeah, insurance, right? You're gonna see those inquiries on the report, right? When you pull your credit, you're still gonna see them. You know they're
They
not
didn't,
hurt.
they didn't hurt you. No.
Yeah. And then when your application for debt is a hard inquiry, I think that's the easiest rule of thumb. Application for debt equals hard inquiry. Do we want to get into shopping around, Allie?
Just briefly, a lot of people ask the question, if I go shopping around for a mortgage and 5 people pull my credit score, is that going to hurt me? No, it's going to be looked at with the credit bureaus as one credit pool. You will see those hard inquiries on your credit report. And there's a lot more to that because this can get pretty complex too, just like every other category of the credit report. But I would just say that 30-day window of shopping for a car or a home loan is not going to negatively impact you like you got 100 pools, even though we'll see all.
Like for like, right? So if you got 100 pulls on the car loan and 100 pulls on the mortgage within the same 30 days, that's 2 inquiries, one for the mortgage and one for the auto, right? So like versus like. So you can't just go shopping for everything all at once. And I don't advise getting a car at the same time as a home. So don't hear that as
Let's stress this really fast. Yeah, don't do that, by the way. Yeah, in my space, like I'm gonna be really mad at you if you do that. Buy the car after you bought the home. But then I think it's really important to say that those are the only 2 categories that work that way. If you go shopping at the mall and every retail store wants you to get their credit card because they're going to give you 10% off, you are in trouble if you do that. Like that's each individual one is a hit to your credit score. So I think that needs to be clarified because people do that. I mean, get 10% off. Heck yeah, right? But it could do some major damage.
Yeah, and I think we just have the only other segue we have in this slide is just reminding you that too many new accounts in a short time can reduce credit scores temporarily. It's like it's a red flag that says, hey, am I having financial troubles because I'm trying to get so much debt all at once? So the algorithm, again, it's a risk management tool, right? So if it looks like you're engaging in risky behavior or you might be having financial issues, you're going to see a drop in your score until the algorithm sees, oh, okay, everything's cool. Everything's fine. They didn't open 5 new accounts, right? So.
Exactly.
Okay, so what does this mean in practice? How do you raise your credit score or get a high credit score, maintain a high credit score? A couple of different ways. Removing errors and compliance issues from the credit report. Adding positive information through credit building tools, which we peeked a little bit on some of them. Don't pay off loans first, pay off credit cards first. Don't close accounts unnecessarily. Oh, I'm zooming in again. And don't be afraid of credit cards. I don't know how to zoom myself out without stopping the live, so we're going to be really close for the rest of the Zoom.
We love your pretty face. Don't worry.
Hello. So I think those are the main things to take from it. And removing errors and compliance issues, often that's going to be related to maybe balances reporting when an account's closed, for example, or misinformation on the credit report. You're reported delinquent when you weren't. So I've seen that sometimes where last payment on an auto loan is reported delinquent even though you paid it on time. Right? Those are some errors or negative information that's reporting with errors, with issues, right? There's a compliance issue there. So adding positive history to the credit report, how can we do it without getting debt? We can add our rental payment history. I've got to scoot back. We can add utility bills. We can use other credit building options, right? Like Allie mentioned, the credit builder accounts. There's debit cards that report to credit now. There's all different ways and types of debit reporting accounts. Some that with your subscription services, right? Experian Boost is a free one that adds the utility bills, and there's a whole bunch of other ones. I don't know what I'm forgetting there, but there's tons of credit building tools, not all made equal. On our website, we do have links to tools that we vetted. So if you are looking for credit building, you can visit our website, creditscorepro.ai. We'll have it in the end here too today. So okay, common misconception. We already talked about this. I just jumped ahead. So I'm going to skip this. This is just telling, you can move your credit card debt to installment. It helps your scores, right? Checking my credit score lowers my score. So credit monitoring, if you are checking your own credit via monitoring, that is not adversely impacting your credit score. Okay. So the last caveat I have to this is free doesn't always mean free. This is my special call out to my best friends over at Credit Karma. I am not a fan of Credit Karma primarily because of what they do with your data. Your agreement for them to give you your Vantage scores for free is so they can mine all your data. They can take all the data they want on you and they can sell it to other financial institutions who target advertising to you. That's why it's free. So I'm not a big fan of Credit Karma and the entity that owns them that shall not be named, but you can get your scores free on there. I recommend using paid platforms. We love Smart Credit for 1,000,001 reasons. They're a wonderful company, amazing ethics, and they do a lot for you, right?
And your information's private. And I think that's so important.
Yep,
I love that
that's where I
you
was gonna
brought that
go.
up with Credit
Yeah.
Karma. And I saw John shaking his head too. One of my biggest pet peeves of Credit Karma, besides them selling all your data, is they will say, oh, based on your credit and your situation, you should get this loan. It'll be like a One Main Financial or a Mariner Financial that the person didn't even need. And they get this debt at 25% interest rate because Credit Karma told them they probably should. And I've had people call me and like, oh, I just got that debt because Credit Karma told me to do it. I'm like, wow. I mean, so now you have this debt with this horrible interest rate. And you know what you did? You went and spent the money off the loan you got because, why not? You got the loan. That's what you got it for. So now you actually have to you do have to pay this thing back and you don't have the money to pay it all the way off right now. And it's just a bad situation. But Credit Karma advises things that are not necessarily advisable because they get paid per click.
I think they also use Vantage, and normally with my mortgage customers, they say, oh, I've got a 780 credit score.
Yeah.
And we run the tri-merge and it's 753, and they don't understand that.
Yeah, that's an education thing because a lot of the credit monitorings, do use Vantage because it's cheaper. But FICO is really expensive. Even the mortgage companies are getting crushed right now because of how expensive that FICO credit report is. But it's a confusing process, and that's where we educate people on what those scores are. So my simple way of saying it is the mortgage credit reports are just mean.
Yeah, exactly. Okay. We are so over on time, so I'm sorry. So I'm going to speed through. Paying collections raises my scores, right? So collections are worth a ton of points. I'm going to summarize real fast. Collections are worth tons of points on the report. Paying a medical collection automatically removes it from the credit report, and that can cause a boost in credit scores. Paid collections only help some FICO score models and Vantage score models. Blah, I can't talk. So just know not every FICO algorithm is going to cause a score boost from paying a collection, with the exception of a medical collection or a negotiated payment in exchange for the account being deleted from the credit report. Okay, so that's really important. And I'm going to leave it at that. We can talk about collections in more detail in another webinar. Anything you really have burning that you want to make sure we covered in that, Allie?
No, I think you said my burning things. I think.
Okay.
I do have a burning thing.
Okay.
But never pay a collection on your credit report just because it's on your credit report. Make sure to dispute it first, because these collection companies either are servicing or bought the collection, and they may not have any verification that you owe it. You may indeed not owe it. I've seen double booking on medical collections, all kinds of things. So never, never, never go on your credit report and say, I'm just going to pay all this stuff off. Like, don't do it. Don't do it.
Please.
definitely challenge it first.
I agree 100%.
Good.
We already talked about this, so I'm gonna move on. You need a credit card.
You need a credit card.
We talked about inquiries, and credit's important, and you all know it, right? It impacts everything. This is my word of caution. Allie already talked about this a little bit. Just don't go and apply for every single thing under the sun to try to build your credit. There's predatory lenders out there. There's predatory credit building things out there too, or just things that aren't as good. And just be really careful.
Just go to our website. We've already vetted. So
Yeah.
Seriously,
Okay,
not a marketing piece here. Really, people, I really truly advise you go to creditscorepro.ai where the credit building resources are. We vetted those. They're not like, and I'm gonna say the name of this company, First Premier. Everyone has one. They're a subprime lender. They charge a horribly high annual fee, and every single month, whether you have a balance or not, they charge a monthly service fee. There are some really bad credit building resources out there that are just targeting people who are in trouble. And that's sad, but it's true. And in every industry, it's true, right? But go to creditscorepro.ai. There's the best of the best credit building resources.
Yeah. So what we use with our what we have available, what we use with our client base is Credit Score Pro AI. So we mentioned in the beginning, we founded Credit Score Pro AI. It's essentially a tool that helps consumers and professionals with managing every single aspect that we already talked about today. So Credit Score Pro AI automatically analyzes the credit report. So credit report is imported via Smart Credit. So that's our partner. It reads the credit report. It's looking at the raw data credit file on the back end. That's this beautiful picture here on the right side of the screen. That's what your credit report looks like before it's made pretty, like what you see on the left-hand side of the screen, or if you're in a professional and you get something from a vendor. That's just what they want you to see. This is the back end. So Credit Score Pro AI can read all of this information, and not all of it is going to be shown by the vendor. That's so very important, because when you have negative information on your report, it is able to find those errors that you can't see when you're looking at that credit report on the left-hand side, right? It goes through all that code, finds errors, creates the disputes automatically. All the user has to do is check the box of the accounts they want to dispute. Obviously, we're going to recommend the negative accounts. And then from there, you'll see right here, AI has a suggested dispute based on thousands and thousands of previous disputes that have been done based on the success rates and lack of success rates. It determines the most appropriate dispute based on the errors plus success rates. And then from there, the only time we would suggest changing that dispute is going to be if there's fraud, right? Our AI doesn't know if someone opened an account in your name. It doesn't know about identity theft, right? And the great thing about Credit Score Pro AI is now the consumer, the professional, they do not have to be a credit expert. It understands what the best disputes are and the way the bureaus respond to those disputes.
Literally, you don't have to read the credit report. The credit report's inside of Credit Score Pro. You can read it, but it's going to analyze it for you. You're literally just clicking. So you don't have to know all this stuff that we just went over to use Credit Score Pro and get the results. You don't have to know all that stuff. And that was important when we created this.
Yeah. And so it's automatically going to create the disputes, create this dispute letter, address it to the credit bureaus. All that the user has to do is click a few buttons, click print, and send it to the bureaus. We do realize as well that it is 2024, and some people either don't have printers or don't want to print, even though our recommendation is always to print and mail the disputes yourself. But we work within the realms of what people want. So we have an option where the user can just use a mail service that we have integrated. So they can just click and the disputes can be mailed for them as well. But we talked about all these other factors that impacted scores, right? Payment history is just one factor, 35%. What about the other 65%? So Credit Score Pro is meant to bridge that gap. We want to optimize the good accounts, get as many points out of those good accounts as we can. And then we want to fill in the gaps. Where are we not influencing the credit score algorithm? But also consider that goal. Are they trying to buy a house? What credit score algorithm is most important based on their goal? Are we looking at those old FICO scores? Are we looking at the newer FICO scores? So that's all factored in. So a consumer is going to just pick their goal. Let's say it's to buy a house. And then from there, Credit Score Pro AI says, this is the best action plan for you based on the way your credit report looks like right this second, and based on that goal, right? How does this algorithm function versus a different algorithm, right? And as you achieve each of your action plan steps, the next updated action plan is going to show you what steps you've achieved, right? It wants to tell you, great job.
Congratulate you.
Yeah,
Congratulate you.
you did it. And then
You
it's
did
going to tell you what the next most beneficial steps are. So it's not meant to overwhelm you with every single possible thing you could ever do, but it gives you the most pertinent, most impactful things to start with. And as you start checking those boxes, it's going to fill in with the next most important things. And the action plan can be updated as much as you want. You can change your goals as much as you want, but it does automatically update every time a new credit report is available. Did I miss anything? No?
No. No.
Okay. The last part, credit building. We talked about it. So the credit building tools are going to be recommended as part of this action plan when they make sense. They're also available, like we mentioned, on our website. And then the final piece is the credit coaching. So you also probably want to know how credit works, right? That's part of why people are here today. Hopefully that's why people are watching who aren't here live. But Credit Score Pro is meant to give you every single aspect you could ever want to know about credit in little bite-sized pieces. So little 5-minute to at most 10-minute increments. So you understand all of the aspects of credit, understand those myths. You can sift through all the baloney that you see on social media and know the actual facts about how credit works. And then you have a section that's really focused on establishing and reestablishing credit to refine what this action plan is telling you to do. It gives you all of the whys, right? All of those details. And it makes it so you don't have to be the expert. The AI can do it all for you, and you can learn all the pieces you want to know so you can be empowered and have the resources needed. So we are sick of people not having access to the information and not having the tools that they deserve and that they need to have the opportunity to have strong credit, right? That's the key.
And finances,
Yeah.
and finances. And,
Yeah.
I love that we have the coaching section because their financial literacy is almost non-existent. And some of the information that people are getting, especially millennials, Gen X's, they're going on social media, they're getting information that's not always true and accurate. And that's a big pet peeve of mine and Ivory's.
Yeah.
So this is giving them that factual information. But again, we have people who they say they want to know about their financial literacy, but really don't. They just want someone to do it for them. So we have both, right? So you could use the tools with Credit Score Pro AI and not have to know everything in the back that we've been talking about today. And it gets more and more complex as we go. But if you do want to know, it's available. And so that was really important to us on the development of this. It was probably one of our most important pieces. We wanted to bring financial literacy to everyone and have it accessible.
And the great thing about it too is we have both professionals and consumers using it, right? So professionals can sign up to have their clients use it. And then they themselves can sign up directly if they want to maintain their own credit, have access to all of the financial literacy, credit education tools. Or consumers can go directly online and sign up on the website too, if they're not affiliated with any particular professional. But the whole point is it is your resource no matter where you are, and it's meant to be the most comprehensive resource. There's nothing out there this comprehensive at this point. And so we just wanted to make sure people had access.
Hey, Ivory, you made a great point. I just want to just recap on that.
Yeah.
We have a lot of credit professionals using Credit Score Pro. They don't have any credit issues, but they give that tool of those coaching things and to learn about credit so that when they're, because if you're in the credit industry world, you're a professional in that, you are the trusted advisor. And so people are going to come in and ask you questions that hopefully you have the answers to, right? If you don't, you can call us. But Credit Score Pro, getting inside there and learning about that and going through the coaching stuff is invaluable for, I mean, well, let's talk about the cost. What does it cost, Irene?
Oh yeah, I always forget that. So the AI is actually free.
Free.
So the
There's a
AI
catch.
is completely free. The catch is you have to pay for your credit report. So credit monitoring. Go ahead.
Because we need the credit report. We have to be able to read
Yeah.
that credit report, right?
Exactly. Credit monitoring with Smart Credit is $39.99. You get access to all 3 credit bureaus separately, so individual report for all 3 bureaus, access to a whole bunch of other tools. You have insurance for identity theft. You also get, I mean, they have a
Privacy
whole bunch of
is a lot. There's a lot.
Yeah.
Smart Credit by itself is just an amazing product. But you combine that with getting everything you get with Credit Score Pro, it's unmatchable, right? There's no other software out there that provides this robust ability for consumers or for professionals. And I think that's important. Hey, can we mention our Facebook page that we're trying to grow?
Yeah, it's right there at the bottom.
Can we call it out though? Can we call it out? So Credit Score Pro, the AI credit revolution, we encourage everyone to get on that. It's a great platform for both consumers and professionals. So professionals have questions, consumers have questions, but if you're a professional on this live, know that we need more of you in the group to answer questions. Okay.
Yeah, absolutely. So we are trying to bridge the gap. Basically, we wanted something that's cost effective and accessible for everyone. So yeah, John, I can answer some of those questions more too. I'll chat with you on offline here. And with that, since we're super over on time, we don't have any more time for questions today. So, feel free, if you have other questions, you can email us at support or info@mycreditscorepro.com. Or if you're live, you can, or not, you're watching the live. I can't talk anymore. If you're watching the live, put something in the comments and we will see you next week. So we are here every single Thursday. So next Thursday is coming up a event for specifically geared towards professionals. And then the following week will be for consumers again. So we go back and forth. So thank you everyone for joining.
Thank you both.
Yeah.
Say hi to the lovely Terry for me.
I will. I definitely will. She's just right outside the door.
She's so wonderful. Okay. Talk to you soon.
Thank you, lady.
Yeah.
Thank you, Courtney. Have a great day.
You
Bye.
too. Thank you.
Enjoy the sunshine.